On the financial planning part, there are two components that you need to look at. One is your financial story as you need to see it from an implementation point of view, and the summary of that story that you need to present in the pitch presentation. Let's come to the first part, which is for you to understand if this is a good business that you want to risk your invest your life into. One of the mistakes that I see a lot of entrepreneurs do is take a snapshot 1-year view or 2-year view at a macro level, saying that these will be the total cost of my manpower, this is the total rent, and so on. What I urge startups to do is look at this on a month-on-month basis for at least a 2 to 3 year framework. Put the various cost components down. There are two broad areas in which your cost will sit. One is capex or capital expenses, and the second is opex or operating expenses. The opex again will be divided into what is called fixed expenses and variable expenses. Fixed would be things like a rent, salaries, internet charges, and so on and so forth, which you need to pay on a month-on-month basis, whether you have 0 customers or whether you have a certain number of customers. And the variables will be things like travel, marketing, and so on and so forth. And these are the kind of areas that would probably you have a slight amount of. If you make a very, very detailed list with all your row items of all the costs that you're likely to incur into a thing and put it down on a row by row basis, and then have on the column side on a month-on-month, monthly thing, it gives you a good snapshot of what your cash flow requirements on a month-on-month basis are likely to be. On the basis of those cost structures, figure out that if I spend so much on marketing, if I have these kind of resources, what am I likely to get? How many customers will I get? How many consumers would I get? How many users would I get? And so on and so forth. And as a result of that, what is likely to be the revenue? The gap between your revenue and your cost structures is going to tell you what your cash flow requirements for that particular month are. Now, a common mistake again that a lot of entrepreneurs do is to not differentiate between fund flow requirement and cash flow requirement. Let me illustrate with an example. Assuming that your annual revenue for that particular year, or say year 1, is going to be 50 lakhs. And assuming that your expenses for that year are likely to be, say, 75 lakhs. Now, if you take an annual snapshot, you will probably be seeking 25, 30, 40 lakhs funding to, maybe 25 lakhs to cover up for this, and maybe a little bit buffer. But when you do your month-on-month exercise, you'll probably realize that it takes about 50, 60 lakhs for my costs to, to keep on adding up before the revenues start coming in, and therefore, while at an annual level you may still require, or at an annual level there may be a gap of 25 lakhs, at a particular time, maybe the 7th month, maybe the 8th month, maybe the 9th month, or some stage, there would have been a cash requirement of about 40 to 50 lakh rupees. Now, if you don't take that call between fund flow and cash flow, you may end up underfunding your startup, and therefore, even if you're on the right track, you may lose out on being able to carry on with your venture.